Hey everyone, investing can be stressful. The market's like a roller coaster, sometimes throwing you for a loop. One minute you're up, the next you're down, and it can feel like all your hard-earned money is along for the ride. It's easy to get caught up in the hype, the fear, the what-ifs. But here's the thing, you don't have to be a prisoner of your emotions when it comes to your investments. You can absolutely crush it in the market without turning into a ball of stress every time there's a dip. In this video, we're going to break down how to manage those emotions like a pro, how to make smart decisions even when the market feels like it's going crazy, and how to stay calm, cool, and collected, even when everyone else is losing their minds. And to make sure you're equipped to handle anything the market throws at you, stick around until the end because I'm going to share a checklist that'll help you take the emotion out of investing and put you firmly in the driver's seat. Now, before we dive into the nitty-gritty of staying calm amidst the market chaos, we need to talk about something super important: your brain. That's right, the very thing that's supposed to help you make rational decisions can sometimes be your worst enemy when it comes to investing. You see, our brains are hardwired to protect us from danger. And for our ancestors, danger looked like a saber-toothed tiger, not a fluctuating stock portfolio. So when the market takes a sudden nosedive, your brain interprets that as a threat and kicks into fight-or-flight mode. Suddenly you're hit with this overwhelming urge to do something, anything, to escape the perceived danger. This is where panic selling rears its ugly head. You see your portfolio shrinking and your brain screams, "Sell, sell, sell," before things get any worse. But here's the kicker: acting out of fear almost always leads to bad investment decisions. You end up selling low, locking in losses, and potentially missing out on future gains when the market inevitably recovers. Alright, let's dive into some of the most common psychological traps that can sabotage your investment success, starting with the one we all know and dread: panic selling. This is the classic knee-jerk reaction to a market downturn. You see your portfolio value plummeting and your brain goes into overdrive, screaming at you to get out while you still can. But here's the thing: panic selling is almost always a bad idea. When you sell your investments during a downturn, you're essentially locking in your losses and missing out on the potential rebound. Remember, the market moves in cycles. What goes down often comes back up, and sometimes even stronger than before. So how do you avoid the panic selling trap? It's all about having a long-term perspective and reminding yourself that market fluctuations are perfectly normal. The stock market is like a roller coaster. There are going to be ups and downs. But if you have a diversified portfolio and a solid investment strategy, you'll be able to ride out the turbulence and come out ahead in the long run. Hey, remember when Bitcoin went from like $60,000 to $30,000 practically overnight? Or how about when the S&P 500 dropped almost 20% in just a few weeks back in early 2020? Those were some crazy times, right? The thing is, those kinds of swings happen. The market doesn't just go up in a straight line. It's gonna dip, it's gonna spike, it's gonna feel like a roller coaster sometimes. But, and this is important, these drops are normal. They're a natural part of the market cycle. Think about it like this: would you be surprised if your favorite coffee went up or down in price by $1 or $2? Probably not, right? The market is kind of the same way. Prices fluctuate, and that's okay. What matters is that over the long term, the market has historically trended upwards. So, next time you see your portfolio in the red, take a deep breath. Don't panic. Volatility is normal. It's a feature, not a bug. Now let's talk about how you can be prepared for these ups and downs so you can stay calm, cool, and collected when they inevitably happen. Alright, before you make any investment decisions, it's crucial to take a step back and ask yourself some key questions. This checklist will help you stay grounded and avoid those impulsive moves that can really hurt your portfolio in the long run. Remember, investing is like building a house. You need a solid blueprint before you even think about laying bricks. First and foremost, do you have a long-term plan? I'm talking about a clear investment strategy that outlines your financial goals, risk tolerance, and the time horizon you're working with. Without a plan, you're just throwing darts blindfolded, hoping something sticks. And let me tell you, that's not a winning strategy. This plan should be your North Star, guiding you through those inevitable market storms. When you're tempted to make a rash decision based on fear or greed, pull out your plan and remind yourself why you're invested in the first place. It's all about staying focused on the bigger picture. Think of it like this: If you're driving across the country, you wouldn't just hit the gas and hope you end up in the right place. You'd map out your route, plan your stops, and maybe even factor in some detours. The same logic applies to investing. A well-defined plan keeps you on track and helps you reach your destination. Remember, investing is a marathon, not a sprint. There will be ups and downs, bull markets and bear markets, times of euphoria and times of uncertainty. That's the nature of the beast. The key to long-term success lies in your ability to stay the course, weather the storms, and not let your emotions derail you from your financial goals. By understanding your own psychology, recognizing those common investing traps, and having a solid plan in place, you're already ahead of the game. And remember that checklist we just went through? Keep those questions handy whenever you're faced with a major investment decision. They'll help you stay grounded, make rational choices, and avoid those impulsive moves that can really hurt your portfolio in the long run. Now, I know this stuff can seem complicated, but it doesn't have to be. The more you learn about investing, and more importantly about yourself as an investor, the more confident and in control you'll feel. Thanks for watching. I hope you found this video helpful. Don't forget to check out the description box below for any resources or links mentioned in this video. See you in the next one.